So next on the list is Alexandria, the real estate company. They do these sort of, I think they're called mega hubs off the top of my head, but it's these big centres for biotech companies to sort of crowd together and innovate and rent space from them as they're a REIT. So the results were quite interesting. The market didn't really like them, but here's the sort of headline bits for you as quickly as we can do them. So FFO, which is funds from operation, which is interchangeable, I suppose, with EPS if you were thinking about a normal stock. So funds from operation per share, that grew 5.6% in 2024, which was a tough macro sort of conditions for Alexandria. So to see growth is good. Q4 leasing volume was about 1.31 million square foot. That's up 47.3% year on year. Full year 2024 leasing was 5.05 million square foot, up 17.3% year on year. Rental rate increases were 16.9%, 7.2% on a cash basis for 2024. Alexandria's got about $540 million of pending dispositions for 2025, and their occupancy has remained stable. It's normally around 95. It's not one of these 99.9% REITs. It's always around the 95 mark, and it was 94.6. They were really keen to point out, and every time I talk about Alexandria, I think it's a good REIT, but they were keen to point out some metrics that they always point out. But net debt and preferred stock to adjusted EBITDA of about 5.2%, which is pretty good for the industry. They've got liquidity of around $5.7 billion. 32%, so around a third of their debt doesn't mature until 2049 or beyond. 12.7 years weighted average remaining term of debt. Since 2020, an average of about 98.4 of their year-end debt balances have been fixed. Total debt and preferred stock to gross assets, which is another way of measuring their debt, 28%. 684.1 million of capital contribution commitments from existing real estate joint venture partners. This is to fund construction from the first quarter that we're going into now in 2025 through to 2028. Had a quick look around the analysts, Steve. Analysts are rating 5 as a strong buy or buy, 9 as a hold, and there are 0 sells and 0 strong sells. The consensus recommendation for the commercial REITs peer group, just so you know, is also a buy. So Alexandria sits in a group of commercial REITs where analysts think they're essentially all a buy. What was interesting in the report, Steve, 500 million buyback initiated. That's twice I've done that, 2 weeks on the trot. 500 million buyback initiated, which they've done 200 million of already, Steve, because I think the shares must have been irresistible to them at 98.16, which was the average price that they picked them up. I agreed with them, Steve, and I also picked up some more. I think it's a very, very good REIT, and I'm not really sure, other than the Robert F. Kennedy stuff, what the market doesn't like about this one.
I think what the market doesn't like about these is they have quite a heavy exposure, if I remember rightly, to Moderna. I've just tried to check this through ChatGPT, which I don't necessarily trust to give me the right answer on this, and they've given me a number for how much of its rent comes from Moderna, which I'm pretty convinced is wrong, because ChatGPT has given me the answer of 2.6%. It ain't that. It's, I think, quite significantly higher than that. You might not think it's problem high, though. And I also, if I were an analyst looking at this stock, would not have a sell or strong sell rating on this. I would probably say buy, and I quite like this relative to certainly a number of other REITs as well. It's very specialised. I'm interested in when their kind of Moderna leases roll off, because that company hasn't been doing terribly well lately. I don't see it as a bankruptcy, though, and it's highly plausible to my mind that if they're not a bankruptcy, I mean, REITs are not bonds, but they're not a million miles from bonds in the sense of they don't grow massively. The numbers from Alexandria are good, but not hyper growth numbers, and it's unlikely you'll see hyper growth numbers. But the idea is that you get a big enough starting return on them and enough predictability about how that will move forward. It doesn't really matter. Cash is cash, however it comes in. So looking at them, I think in the case of Moderna, the other thing about the bond-like nature of these things is people are going to pay their rent even if their profits go down. They don't have a choice in the matter. They will also renew, and it'll be interesting to see how they go when they renew. But I think that's their kind of main concern. That doesn't make any sense, though, of why the stock didn't react particularly well to these earnings, because that hasn't changed recently. Those contracts have been in place for, well, years, possibly more than a decade to this point. So there's been plenty of opportunity to see this coming. That was why I thought it had a biggish yield beforehand. But you can stick this in the bucket of stocks from this show that I am in principle interested in. I don't know whether it's top of this list, but it's on there.
I didn't see exactly what Moderna exposure is, but I did see in the earnings that no client at the moment is contributing more than 3.5% of revenue to Alexandria. So that number from
fair enough. That might be right from ChatGPT.
Might be somewhere near, considering I think Squib is a pretty large tenant of theirs. So I would assume Squib's probably got the most. The most of the office space. But yeah, I largely agree with you, Steve. If you look at the other occupancy rates for people in their sector, you'd probably be looking at SL Green, which has some of this, but not a lot. They're about 89%. And the other one I guess you would say is Boston Properties. And last I checked on Boston Properties, it's been a while, they were about 89%. So for Alexander to be in the 95s is pretty good. It's better occupancy. And just go back to that short report, Steve, where the guy outside said he was tracking mobile phone signals and said that nobody was in the offices at Alexandria, and that meant the whole cluster had shut down. That just hasn't come to be at all. But the stock has never really recovered from that short report, and I don't know, Steve. I can't look at the trading report here and see anything that I'm particularly worried about. They did put a little bump on the dividend as well. They seem to be performing quite well, and I'm happy to keep buying at the moment, and we'll see where this one goes.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.